Gold or Bitcoin? Which is the safer haven in 2024? A question that sparks heated debates among investors. As we navigate the investment landscape, we encounter myriad opportunities, each promising its own unique set of rewards. The key to successful investing, however, lies in diversification. By spreading our investments across a variety of assets, we can mitigate risks and increase our chances of reaping substantial returns. Enter the age-old debate. Gold or Bitcoin? Gold, the traditional safe haven, has been a bedrock of stability for centuries. It's tangible, finite, and has intrinsic value. When economies tremble and currencies falter, investors have long turned to gold as a safe harbor. It's the old guard of investment, reliable, unchanging, and steady. But as we stand on the brink of a new era, a digital contender has emerged. Bitcoin, the pioneering cryptocurrency, represents a new-age digital asset. It's intangible, decentralized, and its value is driven by supply and demand dynamics of the market. Bitcoin offers a level of potential returns that gold can't match. Yet, with high rewards comes high risk. The volatile nature of Bitcoin has seen it swing wildly in value, sometimes within a single day. It can be a roller coaster ride that's not for the faint-hearted. On the other hand, while gold doesn't have the same meteoric rise potential, it has proven to be a steady store of value. Its price may not skyrocket overnight, but it also won't plummet without warning. In the end, it's not about choosing one over the other, but about understanding how both can fit into your investment strategy. Gold, with its long history of stability, can provide a safety net, while Bitcoin, with its potential for high returns, can be the wild card that propels your portfolio to new heights. Weighing the pros and cons of both gold and Bitcoin, considering their volatility, potential returns, and the role they play in diversification, is crucial to making an informed investment decision. Understanding the pros and cons of both gold and Bitcoin is crucial to making an informed investment decision. Let's dive deeper into the world of gold, the timeless treasure. Gold, with its age-old allure, has always been a trusted safe haven for investors. One of its key advantages is its stability during economic downturns. When stocks plummet and the economy hits a rough patch, gold tends to maintain its value, providing a safety net for investors. Another compelling advantage of gold is its universal acceptance. From Wall Street to the smallest village market, gold is recognized and valued. Its universal appeal transcends borders and cultures, making it a truly global asset. But what really sets gold apart is its intrinsic value. Unlike paper currency or digital assets, gold has value in and of itself. It's not just a symbol of wealth, it's a tangible asset that you can hold in your hand. Gold's resilience and universal acceptance make it a reliable choice, especially during times of economic uncertainty. Moving on to the digital frontier, what makes Bitcoin an attractive investment? Let's delve into the world of cryptocurrency, where Bitcoin holds the crown. An aspect that sets Bitcoin apart from traditional investments is its potential for high returns. Yes, it's volatile, but this volatility has led to unprecedented gains for early adopters and savvy investors. What's more, Bitcoin's acceptance is growing at an impressive pace. Businesses, large and small, are starting to accept Bitcoin as a form of payment. This growing acceptance is a testament to the cryptocurrency's potential and staying power. Another factor to consider is the appeal Bitcoin holds for the tech-savvy generation. Today's younger investors are comfortable with digital technology and are drawn to the innovation and potential of Bitcoin. Bitcoin is not just a currency, it's a technological revolution. It's a digital asset that's pushing the boundaries of what we consider as currency. Bitcoin's potential for high returns and increasing popularity, particularly among younger investors, paints a promising picture for its future. However, every coin has two sides. What are the potential risks of investing in gold and Bitcoin? Let's delve into the less shiny aspects of these investments. Starting with gold, it's important to remember that gold is a physical asset. This means it requires storage. Whether you're stashing it in a home safe or a bank vault, there are costs associated with keeping your gold secure. And let's not forget about insurance. These costs can chip away at your investment returns over time. Then there's liquidity. While gold is universally recognized and can be sold virtually anywhere in the world, it's not as easy to sell as, say, stocks or bonds. It can take time to find a buyer willing to pay a fair price, which could be problematic if you need to liquidate your investment quickly. Now let's turn our attention to Bitcoin. The first thing to mention is volatility. Bitcoin's price can skyrocket or plunge in a matter of days or even hours. This roller coaster ride can be stomach-churning for investors who prefer stability. Furthermore, Bitcoin is a relatively new asset class. It's less than 15 years old and its future is still uncertain. This brings us to regulatory risks. Governments around the world are still figuring out how to deal with cryptocurrencies. New regulations or bans could significantly impact the value of Bitcoin. Lastly, while Bitcoin transactions are secure, the platforms where you buy and store Bitcoin may not be. We've all heard the horror stories of exchanges being hacked and investors losing their entire Bitcoin holdings. In conclusion, there's no such thing as a free lunch in the world of investing. Both gold and Bitcoin have their downsides. With gold, you're dealing with storage, insurance, and liquidity issues. With Bitcoin, it's the volatility, regulatory risks, and potential security concerns. Despite their potential benefits, both gold and Bitcoin carry their own set of risks that investors must consider. So, as with any investment, do your homework, understand the risks, and invest wisely. So, gold or Bitcoin? Which should you choose as your safe haven in 2024? The question isn't as straightforward as it seems. Both assets have their pros and cons that we've discussed. Gold, the time-tested and universally accepted investment, offers reliability and a hedge against inflation. Bitcoin, on the other hand, the digital gold of the 21st century, presents an opportunity for high returns, albeit with high volatility. The decision, however, should not be a one-size-fits-all verdict. The choice between gold and Bitcoin should hinge on your individual risk tolerance, your investment goals, and your understanding of each asset. If you prefer stability and have a conservative investment approach, gold could be the choice for you. But if you're willing to embrace risk for potentially higher returns and have an understanding of cryptocurrency, Bitcoin could be your golden ticket. Whether it's gold or Bitcoin, the choice ultimately depends on you, the investor. Always remember, informed investing is smart investing. Are you a gig worker struggling to manage your finances? You're not alone. Financial planning is crucial for everyone, but it takes on a whole new dimension for those in the gig economy. The game rules are a bit different here. Instead of a steady paycheck, you're dealing with fluctuating income. Instead of employer-provided benefits, you're on your own. And let's not forget about the tax complications that come with being your own boss. These unique financial challenges can seem daunting, but they're not insurmountable. With astute planning and strategic decisions, you can navigate through these hurdles and achieve financial stability. It's all about understanding your income, managing your taxes effectively, and planning for retirement even when retirement seems a distant speck on the horizon. But don't worry, we've got you covered. Let's dive into how you can effectively manage your finances as a gig worker. So buckle up and let's get started on this journey towards financial empowerment. The first step in financial planning as a gig worker is to understand your income. Now, why is this so important? Well, as participants in the gig economy, your income might fluctuate more than those with traditional jobs. You might have times of feast, where the gigs are rolling in, and times of famine, where it's a bit quieter. This unpredictability makes tracking your income and expenses crucial. Imagine driving a car without a fuel gauge. You wouldn't know when you're about to run out of gas and get stranded. Similarly, without a clear understanding of your income and expenses, you might find yourself in a tight spot financially. Now, you might be asking, how do I track my income and expenses? Well, you're in luck. There are various tools and methods to help you. You can use an old-fashioned spreadsheet if you like crunching numbers. Or, you can use one of the many budgeting apps available. These apps can connect to your bank account, track your income and expenses, and even categorize them for you. They can give you a real-time snapshot of your financial health, helping you make informed decisions. A robust budgeting system can help you weather the ups and downs of gig work. It can help you save for the lean times, invest in your future, and ultimately achieve financial stability. Remember, knowledge is power. The better you understand your income, the better you can plan for the future. Tax planning is a crucial part of financial management for gig workers. In the world of gig work, you're essentially your own boss, which comes with its own set of tax responsibilities. The first one to note is the self-employment tax. This is a tax that covers Social Security and Medicare, which traditionally an employer would handle. Now that responsibility falls onto your shoulders. You might be thinking, well, how much should I set aside for taxes? A general rule of thumb is to set aside about 20 to 30% of your income. However, the exact percentage can vary depending on your total income and the tax laws in your area. Another important aspect of tax planning is making estimated tax payments. This is where you pay your taxes in installments throughout the year, instead of one big lump sum come April. It's like a pay-as-you-go system, which can make a big difference in managing your cash flow and avoiding penalties. But let's be honest, taxes can be complicated, especially when you're juggling multiple gigs. That's where a tax professional can come in handy. They can help you understand your tax liabilities, find deductions and credits you might not be aware of, and ensure that you're compliant with all tax laws. Don't let taxes surprise you. Plan ahead and stay on top of your tax obligations. With careful planning and perhaps a little professional help, you can navigate the tax landscape with confidence. Retirement may seem far off, but it's never too early to start planning. Just as we chart our course for a vacation, so too should we map out our journey into the golden years. For gig workers, planning for retirement can seem daunting, but it doesn't have to be. You might think retirement plans are a luxury only permanent employees can afford, but that's not the case. Options like individual retirement accounts or IRAs and solo 401(k)s are there for independent contractors. These plans allow you to squirrel away money for your golden years, while also providing tax benefits. Let's start with IRAs. There are two types, traditional and Roth. Both allow you to contribute up to $6,000 per year, or $7,000 if you're 50 or older. The difference lies in when you pay taxes. With a traditional IRA, you pay taxes when you withdraw the money during retirement. With a Roth IRA, you pay taxes up front, but withdrawals during retirement are tax-free. Then there's the solo 401(k). This is a plan designed specifically for self-employed individuals without employees. You can contribute as both an employer and an employee, potentially allowing you to save more than with an IRA. The key to a comfortable retirement is consistent contributions and long-term investing. It's about planting seeds today, so you can reap the benefits tomorrow. Remember, it's not about timing the market, but time in the market. Retirement isn't just for traditional employees. With careful planning, you can secure your financial future. Financial planning as a gig worker may seem daunting, but it's definitely manageable. The journey starts with understanding your income. Recognize that your earnings may fluctuate, but don't let this dissuade you from planning. Instead, use this as a motivator to keep a close eye on your income and expenses. Next, we tackled the complex world of taxes. Remember, as a gig worker, you're essentially running your own business. This means you are responsible for managing your own taxes. It's crucial to keep accurate records, understand your deductions, and set money aside for tax payments. Don't shy away from seeking professional help if needed. A little investment in expert advice now can save you from costly mistakes in the future. And let's not forget about retirement. Just because you're a gig worker doesn't mean you have to sacrifice your golden years. There are several retirement plans designed for self-employed individuals like yourself. Plan now, contribute consistently, and let the magic of compound interest work in your favor. In conclusion, financial planning for gig workers boils down to three key elements: understanding your income, managing your taxes, and planning for retirement. These elements, combined with discipline and consistency, will set you on the path to financial success. Remember, the key to financial success as a gig worker is planning, discipline, and consistency. You've got this. Have you ever wondered how safe your financial resources are against the rising tide of inflation? It's a question that's on many minds, especially in these uncertain times. You see, inflation is a bit like a stealthy pickpocket quietly eroding the purchasing power of your hard-earned money. It's a constant, creeping force that can gnaw away at the value of your savings, investments, and even your income. Understanding and protecting your finances against inflation is not just crucial, it's an absolute necessity in today's economic climate. Because let's face it, no one wants to find out that their nest egg is worth less than they thought, right? But the good news is, there are strategies available to help you weather the storm of inflation. Methods that can help you safeguard your financial future from this often silent, but potentially destructive economic phenomenon. If you're not sure, don't worry. Today we uncover some strategies to help safeguard your finances against potential inflation. First, it's crucial to understand what inflation is and how it works. Inflation is essentially the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. Think of it as a silent thief, steadily eroding the value of your money over time. When inflation strikes, everything becomes more expensive, from groceries to gas, from rent to recreation. It's like a wave that lifts all prices, leaving you struggling to keep your financial head above water. And it doesn't just affect your daily expenses, it can also gnaw away at your savings, reducing the real value of money you've tucked away for the future. But it's not all doom and gloom. Inflation can also stimulate economic growth, as it encourages spending and investment. However, the key is balance. Too much inflation can lead to economic instability, while too little can stifle growth. Getting a grip on inflation is the first step towards protecting your finances effectively. One of the best strategies to protect against inflation is diversifying your investment portfolio. Just as a balanced diet is crucial for our physical well-being, diversification is vital for the health of our investments. It's a strategy that helps to spread risk across a variety of assets and sectors, minimizing the potential for loss and providing a cushion against the unpredictable ups and downs of the market. So, how exactly does diversification work? Picture your investment portfolio as a pie. Rather than filling the whole pie with a single ingredient, you add a variety of flavors to make it more wholesome and satisfying. Similarly, an investment portfolio should be a mix of different types of assets such as stocks, bonds, real estate, commodities, and even cash. The beauty of diversification lies in its ability to mitigate the effects of inflation. When inflation rises, it often affects different sectors and asset classes in various ways. For instance, while inflation may cause the value of cash to diminish, it may simultaneously lead to an increase in the value of real estate or commodities. By having a diverse portfolio, you're better positioned to weather the storm of inflation, as the impact on one asset could be offset by the performance of another. Let's consider an example. Suppose you have a diversified portfolio consisting of stocks, bonds, and real estate. If inflation causes bond yields to rise and stock prices to fall, your real estate investments might simultaneously experience a surge in value, helping to balance out the overall performance of your portfolio. Bear in mind, diversification is not a one-size-fits-all approach. It should be tailored to your individual financial goals, risk tolerance, and investment horizon. A young investor with a high risk tolerance and a long-term investment horizon might lean more towards stocks, while a retiree who prioritizes capital preservation might favor bonds and cash. Remember, diversification is not about putting all your eggs in one basket, but spreading them across multiple baskets. It's about creating a balanced and resilient portfolio that can stand the test of time and inflation. Next on our list is investing in inflation-protected securities. But what are these exactly? Well, inflation-protected securities are types of federal bonds whose principal, or the initial investment, is adjusted based on changes in the inflation rate. This means that as inflation increases, so does the value of the bond, protecting the investor's purchasing power. Now you might be wondering how these work. Let's break it down. When you purchase an inflation-protected security, you're essentially lending money to the government. In return, the government pays you interest over a set period, typically every 6 months. But here's the catch. The amount you're paid is adjusted for inflation. So if inflation goes up, so does your interest payment and vice versa. But what are the benefits? The main advantage is that these securities offer a guaranteed return above inflation, regardless of the economic climate. This makes them a reliable hedge against inflation. However, it's essential to understand that they do come with risks. If deflation occurs, the principal of the bond can decrease. Moreover, the interest rate is generally lower than other types of investments. In conclusion, inflation-protected securities can be a good strategy for those looking to protect their investment from inflation. They provide a way to maintain the purchasing power of your money over time. But remember, like all investments, they come with their own risks. Inflation-protected securities can offer a reliable hedge against inflation, but like all investments, they come with their own risks. Last but not least, building an emergency fund is another smart way to protect yourself against inflation. Now, you might be wondering, how does an emergency fund relate to inflation? Well, it's all about financial preparedness. An emergency fund is like a financial safety net that can catch you during unexpected economic downturns, including those caused by inflation. See, when inflation surges, the cost of goods and services shoot up. This can strain your regular budget, especially if your income doesn't increase at the same rate. That's when your emergency fund steps in. It can help cover these unexpected costs, keeping your day-to-day life running smoothly without the need to dip into your long-term investments. Building an emergency fund is not a one-day affair. It's a consistent effort. Start small, save regularly, and aim to have at least 6 months' worth of living expenses set aside. An emergency fund might seem like a basic step, but it's a crucial one in safeguarding your finances against inflation. So, to wrap up, we've gone over understanding the concept of inflation, the significance of diversifying your investment portfolio, and the benefits of investing in inflation-protected securities. We've also underscored the importance of building an emergency fund. These are all key strategies to safeguard your finances against the potential impact of inflation. With these strategies in hand, you are now better equipped to protect your finances against inflation. Remember, the key is to plan ahead and stay informed. Thanks for watching, and don't forget to subscribe for more financial tips.
Hey everyone, welcome back to Wealthy Horizons, your one-stop source for all things related to personal finance, investment, and building a secure future. If this is your first time joining us, a big welcome to you too. Go ahead and hit that subscribe button and ring the notification bell so you never miss a single piece of financial wisdom from us. Today's topic is a game changer for anyone planning on investing in a child's future education. Yes, we're talking about 529 plans. We'll be dissecting what these plans are, why they're an excellent choice for education savings, and how exactly to go about setting one up. This is crucial information for parents, grandparents, godparents, or anyone invested in a child's educational journey. Before we dive into 529 plans, let's take a moment to understand why saving for education is essential. The costs of education are rising each year, and according to the College Board, the average annual cost for a 4-year private university can be upwards of $35,000. And let's not forget, this figure doesn't even include other expenses like books, housing, and meals. So clearly, having a financial safety net is crucial, and this is where 529 plans come into play. So, what makes a 529 plan so special? First off, it's designed specifically for educational costs, covering anything from tuition and fees to room and board, and even textbooks. But the standout feature has to be the tax benefits. You contribute money after tax, but the growth and qualified withdrawals are tax-free. And in some states, you may even get state tax deductions for your contributions. So we're talking about a double or even sometimes triple tax advantage. Compared to regular savings accounts or even other investment accounts, the 529 plan stands out as a superior vehicle for education savings, all thanks to these tax advantages. Now there are two main types of 529 plans: college savings plans and prepaid tuition plans. Each comes with its own set of features, benefits, and limitations. College savings plans offer more flexibility. They can be used for a broader range of educational expenses, and you typically have multiple investment options to choose from. Prepaid tuition plans are more restrictive, but allow you to lock in current tuition rates for future use, making it a good hedge against rising education costs. Deciding between the two can be tricky and depends on your unique situation and risk tolerance. Do you want more flexibility, or are you looking to lock in current tuition rates? Make a choice based on your specific needs. All right, so you're sold on starting a 529 plan. How do you get going? Step 1. Research plans. Research various plans available to you. Remember, you're not restricted to your own state's plan, so feel free to shop around and compare. Step 2. Open an account. Most plans allow online account opening. You'll need some identification documents and social security numbers for both the account owner and the beneficiary. Step 3. Initial deposit. Be prepared to make an initial deposit. The amount varies but is generally as low as $25. Step 4. Investment choices. You'll often be provided with a range of investment options. Some plans offer age-based portfolios that automatically adjust risk as the beneficiary gets closer to college age. Step 5. Set up regular contributions. The real benefit of a 529 plan comes from compound interest, so try to contribute regularly. Before we wrap up, let's debunk a few myths about 529 plans. It's too late to start. It's never too late. Even a couple of years of tax-free growth can make a significant difference. I'll lose the money if my child doesn't go to college. Not true. You can change the beneficiary to another family member or even use it for your own education. It will severely affect financial aid. While a 529 plan is considered an asset, its impact on financial aid is generally less severe compared to other types of assets. So, there you have it. 529 plans are an incredibly efficient and flexible way to save for education. They're tax-efficient, relatively easy to set up, and provide a sense of financial security when you're looking at the daunting costs of education. If you found this guide useful, please hit that like button and share this video with anyone you think might benefit. And as always, thank you for watching. See you on our next video.
Ever thought about investing in cryptocurrency but felt overwhelmed by the risks? You're not alone. Cryptocurrency, a digital or virtual form of currency that uses cryptography for security, is a relatively new player in the world of finance. It's like a wild west out there with giants like Bitcoin and Ethereum leading the charge. The volatility of these digital assets can indeed be daunting. One day you might see your investment skyrocket, creating visions of becoming the next crypto millionaire. The next day, you could be watching your digital fortune evaporate before your eyes. Yes, the risks are real, but so are the rewards. The potential for high returns in a short span of time is what attracts many to this digital gold rush. However, with the right strategies, investing in cryptocurrency can become less of a gamble and more of an informed decision. One of the most critical parts of cryptocurrency investment is understanding market trends. Market trends serve as the heartbeat of the cryptocurrency world. They are the pulse that tells us what's happening and where we might be headed. From the wild fluctuations of Bitcoin to the steady rise of Ethereum, understanding these trends is essential to your investment strategy. So why are market trends important? They give us a snapshot of the overall health of the cryptocurrency market. They show us which currencies are in demand, which are falling out of favor, and which might be the next big thing. But what's even more important is how these trends can influence your investment decisions. For instance, a rising trend might signal a good time to invest in a particular cryptocurrency. On the other hand, a falling trend might suggest it's time to sell or hold off on investing. Monitoring market trends is akin to reading the tea leaves of the financial world. It involves keeping a close eye on market charts and graphs, staying updated with news and developments, and even joining cryptocurrency communities and forums. Using this information, you can make strategic investment decisions. You can decide when to buy, when to sell, and when to hold. You can identify potential risks and opportunities. Remember, knowledge is power in the world of cryptocurrency. The more you know about market trends, the better equipped you'll be to navigate the unpredictable seas of cryptocurrency investment. Keeping a close eye on market trends can help you make informed decisions and potentially increase your chances of a successful investment. Scene script. Ever heard the saying, "Don't put all your eggs in one basket"? This holds true for cryptocurrency investment as well. When it comes to investing in cryptocurrency, diversification is key. But what does diversification mean, you ask? Well, it's a strategy that involves spreading your investments across various cryptocurrencies rather than focusing on one single coin. You see, the cryptocurrency market is highly volatile, with prices that can skyrocket or plummet in a matter of hours. By diversifying your portfolio, you can spread out your risk and potentially cushion yourself against any sudden market downturns. Imagine this. If you invested all your money into one cryptocurrency and its value drops, you could lose a significant portion of your investment. But if you have your investments spread across several cryptocurrencies, a drop in one coin's value could be offset by the rise in another's. Now, this isn't to say that diversification is a foolproof strategy. No investment strategy is. But it's one way to manage the inherent risks of the cryptocurrency market. And if you do it right, diversification can potentially lead to better returns. Consider this as part of your investment strategy. Research different cryptocurrencies, understand their value propositions, and spread your investments accordingly. Remember, the aim is not to eliminate risk, but to manage it. Diversification can act as a safety net, helping to mitigate risk and potentially increasing your overall returns. Now that we've covered market trends and diversification, let's discuss another important aspect of cryptocurrency investment: choosing between long-term and short-term investment strategies. In the world of cryptocurrency, a long-term investment strategy typically involves holding onto your assets for a year or more. This approach is also known as hodling. The goal here is to weather the storm of market volatility and reap potentially massive rewards as your chosen cryptocurrencies appreciate over time. The main advantage of this strategy is the potential for high returns. However, it requires patience and a strong stomach to weather the inevitable market ups and downs. On the flip side, a short-term investment strategy involves buying and selling cryptocurrencies over a span of a few days, weeks, or at most a few months. This is often driven by market trends and technical analysis. The primary benefit of this strategy is the possibility of rapid returns. However, it requires constant attention to the market and can be more risky due to the high volatility of cryptocurrency prices. So, how do you decide which strategy is right for you? It essentially boils down to your personal circumstances and risk tolerance. If you're someone who can afford to invest money for a long period without needing immediate returns, a long-term strategy might be the way to go. If, however, you enjoy the thrill of the market and have the time to monitor it closely, a short-term strategy could be more up your alley. Whether you choose a long-term or short-term investment strategy, remember that the key is to make informed decisions based on your personal circumstances and risk tolerance. To wrap things up, let's summarize the main points about cryptocurrency investment strategies. We've journeyed through the risky yet rewarding landscape of cryptocurrency, and it's now time to consolidate our learning. Firstly, we delved into the importance of understanding cryptocurrency market trends. We learned that being aware of market behavior, the highs, the lows, and everything in between, is crucial in making informed investment decisions. We also discussed the importance of keeping an eye on global news and events that could potentially influence the market. Next, we examined the concept of diversifying investments as a safety net. Spreading your investments across various cryptocurrencies can mitigate potential losses. It's like the old saying goes, don't put all your eggs in one basket. We then explored the difference between long-term and short-term investment strategies. Long-term strategies, often referred to as hodling, involve holding on to your cryptocurrencies for extended periods, irrespective of market fluctuations. On the other hand, short-term strategies involve buying and selling cryptocurrencies based on short-term market trends. With these strategies in mind, you are now better equipped to navigate the exciting yet challenging world of cryptocurrency investment. Remember, every investment comes with risks, but with careful planning and strategic decision-making, you can increase your chances of success. Ever wondered what NFTs are and how they can impact your finances? Allow us to demystify this for you. NFTs, or non-fungible tokens, are a hot topic in the digital world. They are a unique breed of digital asset, unlike anything you've come across before. But what makes NFTs so unique? Well, it's all in the name. Non-fungible means that it's one of a kind and can't be replaced with something else. A $100 bill, for instance, is fungible because you can swap it for another $100 bill, and you'll still have the same thing. An NFT, on the other hand, is more like a collectible baseball card, distinct and irreplaceable. Moreover, NFTs can represent just about anything. From digital artwork and music to virtual real estate and beyond, the possibilities are virtually limitless. So, NFTs are unique digital assets that can represent virtually anything. But how do NFTs work, you may ask? Well, it's actually quite simple. Let's start with the foundation of NFTs, blockchain technology. Specifically, most NFTs are built on a type of blockchain called Ethereum. Picture blockchain as a digital ledger, a public record book that's not only open for everyone to read, but is also virtually impossible to alter. Ethereum takes it a step further by allowing for the creation of smart contracts, which are self-executing contracts with the terms of the agreement directly written into lines of code. NFTs, or non-fungible tokens, are digital assets that represent ownership or proof of authenticity of unique items or content. They are one of a kind, hence non-fungible, meaning they can't be replaced with something else. Think of them as collector's items, but in a digital realm. So, how are NFTs bought and sold? This typically happens through online marketplaces such as OpenSea, Rarible, or Foundation. These platforms allow creators to mint or create NFTs and buyers to purchase them, often using cryptocurrencies like Ether. Once an NFT is purchased, the transaction is recorded on the blockchain. This brings us to the key aspect of NFTs, the ownership record. Each NFT has a distinct information or metadata that details its unique characteristics. When an NFT is bought, the transaction is recorded on the blockchain, along with the NFT's metadata. This record, visible to everyone, serves as a certificate of authenticity and proof of ownership. And what about the rarity of an NFT? Well, it's ensured by the very nature of NFTs themselves. Since each NFT has unique metadata and cannot be replicated, it's inherently rare. This rarity, combined with the demand from collectors, can often drive up the value of an NFT. In essence, NFTs blend the worlds of digital art, collectibles, and blockchain technology. They've created a new way to own and trade unique digital assets, opening up fresh opportunities for creators and collectors alike. Therefore, NFTs work by using blockchain technology to record ownership and ensure authenticity. Now that we understand what NFTs are and how they work, let's delve into their financial implications. The world of NFTs is like a new frontier in the digital realm, brimming with opportunities for profit. Just like any investment, the potential for gain in buying and selling NFTs is significant. You've probably heard stories of digital art pieces selling for millions of dollars. A single tweet was even tokenized and sold for close to $3 million. Yes, you heard it right, a tweet. But it's not just about buying low and selling high. NFTs also present a unique way to earn passive income. Many NFTs come with royalties, meaning that original creators receive a percentage of sales each time their work is resold. This creates an ongoing stream of income that can continue for years. However, it's not all sunshine and rainbows. High returns are often accompanied by high risks, and the NFT market is no exception. This market is notoriously volatile. Prices can skyrocket one day and plummet the next. And because the market is relatively new, it's also unregulated. This means there's potential for scams and fraud, so due diligence is crucial. Moreover, the value of an NFT is highly subjective and can fluctuate wildly. Unlike stocks or bonds, which are tied to the performance of a company or government, the value of an NFT is largely based on perception and demand. If demand dries up, so does the value. Yet, despite these risks, NFTs offer an interesting avenue for diversifying investment portfolios. They represent a new asset class that is uncorrelated with traditional markets. This means when stocks go down, NFTs might not necessarily follow the same trend. In conclusion, NFTs can be a profitable venture, but they also carry considerable financial risks. Like any investment, it's important to do your research, understand the market, and never invest more than you can afford to lose. After all, the world of NFTs is fascinating and full of potential, but it's also a wild ride. So buckle up and proceed with caution. So what does the future hold for NFTs? Only time will tell. The acceptance and use of NFTs are growing at a rapid pace, and this trend doesn't seem to be slowing down. The potential applications of NFTs are vast. Take for instance the real estate industry, where NFTs could represent ownership of properties, making transactions smoother and more transparent. In the entertainment industry, artists could use NFTs to sell their work directly to fans, eliminating the need for middlemen and allowing for a deeper connection between creator and consumer. But, as with any emerging technology, challenges lie ahead. One significant hurdle could be regulatory issues. Governments around the world are scrutinizing digital assets, and NFTs are no exception. How they will be regulated is still up in the air, and this uncertainty could impact the growth and adoption of NFTs. The future of NFTs is uncertain, but they are undoubtedly changing the way we think about digital assets and investments. So, there you have it. A simple explanation of NFTs and their financial implications. We started off by understanding what NFTs are, these unique digital assets that are transforming the world of art, gaming, and even real estate. We then dived into the mechanism behind NFTs, elucidating on how they work and how blockchain technology is the backbone of this innovation. We also explored the financial implications of NFTs. We discussed how they're creating new markets, offering novel investment opportunities, and even posing potential risks. It's a dynamic landscape, one that's evolving rapidly, and it's important to navigate it wisely. And finally, we glanced at the future of NFTs. With advancements in technology and growing acceptance, we can anticipate an even more exciting journey ahead. Remember, as with any investment, it's essential to do your research and understand the risks before diving in. Thanks for watching, and stay tuned for more financial insights.